Trading crypto, like Bitcoin or Ethereum, can be a risky business, and it's essential to understand that even the most successful traders experience losses. By understanding probability and reframing failure as not a probability, but as a certainty in winning strategies, we can create a more positive and healthy approach to trading. In this video, we'll discuss the importance of probability in trading, the reality of losses in any winning strategy, and how reframing failure can lead to a more successful trading career. Hey everybody, I am the voice of DeFi, and I love making these videos about the mental side of crypto trading. It's a subject that isn't discussed enough in my opinion. Trading is all about probabilities. Every trade you make is essentially a bet on the direction of the market. It's crucial to understand that even with a high win ratio, losses are inevitable. That's why having a statistical advantage is key to long-term success. By understanding probability and using it to our advantage, we can create a trading strategy that has a positive expectancy over the long run. Probability is the foundation of trading. The best traders in the world understand that every trade is a calculated risk, and they use probability to determine which trades are worth making. When traders have that statistical edge, they know that even though they may lose some trades, they will ultimately win in the long run. One way traders use probability is by using a good risk-to-reward ratio. A good risk-to-reward ratio can really help traders overcome their losses with winners. A risk-to-reward ratio marks the prospective reward an investor can earn for every dollar that they risk on an investment. When traders have a positive expectancy, they know that over time, they will make money even if they experience losses along the way. This is much like a casino. Casinos understand that they will lose money to gamblers each and every hour. They also understand that statistically, they will win more than they lose. So they take those losses and they pile them in with the wins. And at the end of every month, they win much more than they lose. Unfortunately, many traders have the misconception that trading should be without losses, and that simply is not the case. Losses are part of any winning trading strategy, and even the most successful traders experience loss. The key is to understand that losses are not a sign of failure, but are a natural part of the process. It's crucial to understand that even if you have a 60% win ratio, you'll still lose 40% of the time. That's just the nature of trading. But when traders have that statistical edge, they know that even though they may lose some trades, they will ultimately win in the long run. If you're having anxiety about every losing trade, you aren't thinking in the correct mindset. It's also essential to understand that trading is a long-term game. Traders who understand probability and have a statistical edge know that over time, they will make money even if they experience those losses along the way.
You think I'm a failure.
Since we've already stated that failure is not a probability, but a certainty, we have to reframe failure. Reframing failure as a possibility and even a certainty in winning strategies can lead to a healthier mindset. Instead of seeing losses as failures, see them as part of a larger strategy that has a positive expectancy over the long run. A good system with a good edge will still see some losses, but as long as the wins outweigh the losses, then you're on the right track. One way traders can reframe failure is by using a trading journal. A trading journal is a tool that traders use to record their trades and reflect on their successes and failures. By analyzing their trades and identifying patterns, traders can learn from their mistakes and make better decisions in the future. I should mention that it's also very important to have realistic expectations when it comes to trading. Traders who understand probability and have a statistical edge know that they will experience losses along the way, but they also know that over time they will make money, and it's essential to focus on the big picture and not get caught up in those short-term losses. Patience really helps here. You don't want to find yourself trying to make up for numerous losses with one huge winning trade. That's a good way to blow your entire account. Do not revenge trade. Trading is indeed all about probabilities. It's crucial to understand that even the most successful traders experience losses. But by understanding probability and having a statistical edge, traders can create a strategy that has a positive expectancy over the long run. Traders must also understand that losses are a natural part of the process and should be reframed as possibilities or even certainties, even in winning strategies. Remember, trading is a long-term game. By understanding probability, having a statistical edge, and reframing that failure just like we discussed, traders can create a more positive and healthy approach to trading that leads to long-term success. Thanks for watching and happy trading.